Yogah Karmasu Kaushalam.
Hello students, welcome to 408 Financial Markets. I am Professor Ayushi Trivedi. Today we will look at very interesting topic. What are the key components of financial markets? When we talk about financial market, it is whole system. It is not single place where you buy and sell. No. It is whole system where not only you buy and sell, there are also intermediaries who intervene to make that process very smooth and easy. Then there are regulators who regulate and have authority over the market players. So let's look at them in detail. In today's session, we will start look at two important component. In next session, we will continue with other three. So let's start with it.
Let's look at components of Indian financial system. There are basically five components. From that, we will cover two today. So let's start with this session. The financial system in India is a well-structured network that facilitates the flow of funds from savers to investors, supporting economic growth and development. It consists of several key components that work together to ensure efficient mobilization and allocation of financial resources. There are main five components of the Indian financial system. First one is financial market, second is financial intermediaries, third is financial instrument, fourth is financial services, and fifth is financial institutions. So market, intermediaries, instruments, services, and institution. How this component work together? Institutions collect saving, market facilitate trading, instrument enable investment and borrowing, services support financial operations, regulators ensure discipline and stability. The components of Indian financial system together create a strong framework for efficient fund flow, capital formation and economic development. Now from this let's look at first component which is financial markets. So what is financial markets basically? Financial markets are platform or arrangement where buyers and sellers trade financial assets such as shares, bond, currencies and derivatives. In India, this may mean investors buying TCS shares on NSE, bank lending to each other overnight in call money market, or companies issuing debenture to issue funds. Think of financial markets as the meeting place of the financial system. Other components like financial instrument, institutions, intermediaries, and services all interact here. Without markets, this component would not have a common arena to connect savers and borrowers. So let's look at the hardcore definition here. Financial markets are organized or unorganized spaces, either it can be physical or electronic, where financial instruments are issued and traded, facilitating the transfer of funds from savers to investors. The financial market play a crucial role in financial system by facilitating efficient flow of fund, investment opportunities, and economic development. Their importance and functions are closely interrelated. So first of all, let's look at importance of financial market. First is efficient allocation of resources. Financial market ensure that fund flow from savers to most productive users. They direct capital toward industries and sectors with higher growth potential. For example, investors buying shares of a growing technology company help it expand operations. Second is liquidity to financial assets. They provide easy buying and selling of securities, ensuring liquidity. Investors can convert investment into cash quickly without significant loss. Selling shares anytime in stock market to meet urgent financial needs is the one of the most important example of liquidity. Then comes the third, which is price discovery mechanism. Financial markets help in determining the fair prices of securities. Prices are determined by demand and supply forces, and for example, if demand for a company's shares increases, its price rises. Fourth importance is capital formation. They encourage conversion of savings into investment, leading to capital formation. Funds raised are used to build infrastructure, industries, and services. Companies issuing shares to finance new factories is one of the examples. Fifth is economic growth and development. Basically, capital formation leads to economic growth. Financial markets support overall economic development. Efficient fund allocation leads to industrial growth and employment generation. For example, infrastructure financing through bonds leads to development of road and power project. Now, after importance, let's look at few important functions of the financial market. How financial market plays role in the Indian financial system. First is mobilization of saving. Financial market collects saving from individuals and institutions. Savings are channelized into productive investment. For example, investment in mutual funds or shares. Second function is facilitating capital formation. They help in creating long-term assets. Funds are used for business expansion and infrastructure development. For example, raising funds through IPOs for new projects. Third is providing liquidity. Markets ensure that investors can easily enter and exit investment. For example, share can be sold anytime on stock exchanges. Fourth is price discovery. They determine the value of securities transparently. For example, stock prices fluctuate based on market conditions. Next function is risk sharing and diversification. Financial market allow investors to spread risk across different instruments. Diversification reduces the impact of losses. For example, investing in shares, bonds, and mutual funds together. Then come facilitating payment and settlement. Financial market ensure smooth execution and settlement of transaction. For example, electronic settlement system in stock exchanges. Next function is promoting investment culture, and it encourages people to save and invest rather than hold idle funds. For example, growth of retail investors in stock market. Then comes supporting government and corporate financing. Financial market help both government and companies raise funds. Government issuing bonds and companies issuing debenture. Ninth and last function is supporting monetary and fiscal policy. They help in the implementation of policies by Reserve Bank of India, government authorities, etc. For example, changes in interest rate affect borrowing and investment. So, in conclusion, financial markets are essential for mobilizing savings, allocating resources efficiently, providing liquidity, managing risk, and supporting economic growth. They act as a bridge between investors and borrowers, ensuring the smooth functioning of the economy. Now, let's look at the types of financial market. First is money market. The money market deals in short-term funds up to 1 year. There are features which are important to money market like high liquidity, low risk, short-term maturity period, basically up to 1 year. There are instruments traded in money market which are, for example, treasury bill, commercial paper, call money, etc. For example, bank borrow and lend funds overnight to manage liquidity. Second is capital market. The capital market deals in long-term funds basically for more than 1 year. So there are sub-markets under capital market. First is primary market where the new securities are issued, and second is secondary market where existing securities are traded. It involves instruments like equity shares, debentures and bonds, etc. A company raises funds through an IPO in the primary market is one of the example, and those shares which are issued through IPO are traded in the secondary market. Now let's look at the participants in the financial market. They involve individual investors, bank and financial institutions, companies and government, and foreign investors. Now let's look at the role of financial market in the Indian economy. Financial markets in India promote investment and saving culture. It supports industrial and infrastructural growth, enhance global integration of the economy, help implement policies of the Reserve Bank of India and Securities and Exchange Board of India, that is SEBI. So in conclusion, financial market act as the backbone of the financial system, ensuring efficient flow of funds, liquidity and economic development. Now let's look at the second component, which is financial intermediaries. Out of five, we have looked at financial market. Now second one is financial intermediaries. The financial intermediaries are institutions that act as a link between savers, those who have surplus fund, and borrowers, those who need funds. They play a central role in the financial system by ensuring the smooth flow of funds across the economy. In other words, instead of you directly finding a company to lend to, you place your money with a bank, mutual fund, or insurance company, and they decide where and how to deploy it. Need for financial intermediaries is as per follow points. First is reduced transaction cost. They handle documentation, monitoring, and information gathering, which ultimately reduce the transaction cost. Second is manage and pool risk. They spread across many borrowers and investors. Third is provide expertise. They have professional managers, credit analysts, and risk experts. Now let's look at the hardcore definition here. Financial intermediaries are institutions that collect funds from the public and lend or invest those funds in productive activities, thereby facilitating capital formation and economic growth. Now, there are few types of financial intermediaries in India. Let's look at them. First is banking institutions. Banks are the most important intermediaries. Its feature is to accept deposit from the public, provide loans and advances, create credit in the economy. For example, commercial banks like SEBI lend funds to business using deposits from customers. Now let's look at the non-banking financial companies, which is NBFCs. NBFCs provide financial services without being full-fledged banks. It has features like they provide loan, leasing, hire purchase, etc. and they do not accept demand deposit. For example, NBFCs finance vehicle, housing and consumer goods. Next comes the insurance company. Insurance companies mobilize saving and provide risk coverage. It has features like it collects premium from policyholders, invest fund in long-term securities, etc. For example, life insurance policy provide financial security in long-term investment. Fourth is mutual funds. Mutual fund pool money from investor and invest in diversified portfolio. It has features like professional fund management and risk diversification. For example, investors can return through equity or debt mutual funds. Then comes the fifth, which is development financial institutions, also known as DFIs. DFIs provide long-term finance for industrial and infrastructure development. It has features like it focuses on economic development project, provide long-term loans, etc. So these are the various kinds of financial intermediaries which plays important role in Indian financial system. Now let's look at the function of these financial intermediaries. So first is mobilization of saving. They collect savings from individual and institutions and allocation of funds. They allocate funds to productive sector like industry and agriculture. Then comes the risk reduction. They reduce risk through diversification and professional management. Fourth is providing liquidity. They offer financial products that can be easily converted into cash. Next comes the cost efficiency. They reduce transaction and information cost. Sixth function is maturity transformation. They convert short-term deposits into long-term loans. Last, let's look at the role of intermediaries in the Indian economy. So, financial intermediaries promote financial inclusion, support industrial and infrastructural growth, encourage saving and investment habit, facilitate economic development. Now, what is the regulatory framework for the intermediaries? Financial intermediaries are regulated by Reserve Bank of India, that is RBI, Securities and Exchange Board of India, that is SEBI, Insurance Regulatory and Development Authority of India, that is IRDAI. These are few of the examples. These regulators ensure stability, transparency, and investor protection. So, in conclusion, financial intermediaries are the backbone of the financial system as they ensure efficient mobilization and allocation of funds, risk management, and economic growth in India. Who regulates financial intermediaries in India? Because intermediaries handle public money, strong regulation is essential. In India, different regulators oversee different types of institutions. So first is RBI, that is Reserve Bank of India. They regulate banks, NBFCs, payment system, etc. Second is Security and Exchange Board of India, widely known as SEBI. They regulate and watch over mutual funds, stock exchanges, market intermediaries, etc. Next is Insurance Regulatory and Development Authority of India, known as IRDAI. They regulate life and general insurance companies working in the India. Then comes PFRDA, known as Pension Fund Regulatory and Development Authority, NPS and other pension fund entities. These regulators aim to protect depositors and investors, ensure fair practices and transparency, and maintain financial stability and prevent systematic crisis. So, if you keep exploring financial market instrument and services, keep asking which intermediaries are involved here. How are they shaping the flow of funds in India's mixed economy? This question approach will help you see how theory connects to real financial activity all around you. So to more clearly understand all the theory, what you can do is you can go through uh, actual financial market, that is NSE website, RBI and SEBI website, to understand how they regulate the all intermediaries in India as well as how intermediaries in India work. You keep on watch you keep watch on news articles, etc., to understand how these intermediaries plays part or important role in Indian financial system and improves and develop the economy.
I hope you enjoyed the session as much as I did explaining it. See you in the next session.